Okay, let's do our 18.3 work together here, which is on issuing our stock. Take a little look-see at this. We've got 4 transactions here for a company called Center Fashion, and we're going to use the cash receipts journal because we'll be receiving cash on all of them. So I'm just going to scroll down here so we can see everything at the same time. So our first transaction is on June 1st, and it says that we sold 6,000 shares of $10 par value common stock for a total of $60,000. So let's put in our date of June 1st, and then let's take a look at if we had anything in excess. So if we take our 6,000 shares times the $10 par value, we end up with 60,000. So we did not have any excess. So our account title for this one is actually just capital stock / common. Okay. And our document number is going to be R258. And then capital stock is being credited for 60,000. And our cash is also, well, I should say, is debited for 60,000. So that's our first transaction. Pretty simple, nothing too crazy there. And if you need a reference, I believe it is slide 32 in our PowerPoint. So let's look at June 9th, which says that we sold 2,000 shares of $10 par value common stock at $10.50 per share for 21,000. So in this instance, because we're selling it for $10.50 instead of the par value, we're going to have an in excess that needs to be recorded this time. So we're going to go down here and put in the 9th. We don't need the month because it's already up there. And so let's record our capital stock common first. And our document number is 267. So the part that's going to capital stock common is the 2,000 times the $10. So that's actually $20,000 when you do that. And then let's go to our next line and record our paid in capital in excess. So paid in capital in excess of par common stock. And this we actually take the 50,000, or not 50,000, excuse me, the 50 cents times 2,000 shares, and we wind up with 1,000. Now you can also, if you wanted to, you could just take the 21,000 minus 20 and you'd get the same answer. Okay. But the total cash that we received was 21. So that's going to go over here in our cash debit. So hopefully that made sense to you. How we're getting that is that we're selling it for more than the par value is. So we do have to record that in a separate account. Again, if you need a reminder on that, slide 34 in your PowerPoint will talk about issuing stock in excess. Okay, then on the 22nd of June, we issued 500 shares of 5% $60 par value preferred stock at par value for $30,000. So this one is a preferred stock. Remember, a little bit different than capital, only in the fact that they have a stated interest rate or stated dividend rate, and that they will always be paid first before common stockholders. So we put the 22nd in for our date, and our account title is oops. Oh, I forgot capital. What am I doing? Capital stock dash preferred. Oh, can't type today. Our 289 is our receipt. And because it says they were bought at par value, we don't have any excess here. So it's just going to be our $30,000 that's going to be credited. And then cash is going to be debited. So another pretty straightforward one. Just make sure that you have preferred instead of common listed here. And then let's do our last one, which is another one where we are issuing common stock, 500 shares at $10 par value, but we're selling them at $11.25 per share. So let's do our math because they were not as kind to give us the total here. So we're going to have to do a little bit of math in our head, which is okay. We are capable of that. So our first thing that gets recorded is our capital stock, common, for receipt number 301. And we issued 500 shares at $10 per share. So when you do that math, that ends up at 5,000. So that's going to be our general credit here. Then because we sold them at 11.25, we have some in excess. So we say paid in capital in excess of par, common. And we take the difference here. So it's $10, 11.25 minus 10 is $1.25. And we take $1.25 times our 500 shares, and we end up with $625 if you do that math. And so the total of those two, our 5,000 plus 625, is the total amount that we received by issuing that stock. $5,625. That was tough to say, but made it through. So those are our 4 transactions in reference to issuing stock. Your biggest thing you have to remember is to pay attention to, are they paying in excess, meaning paying more than par value? Also, if it happens to be a preferred stock listing instead of our typical common stock.